Okay, ladies and gentlemen, as I said, we have the company presentation from PCBL Limited, one of the leading specialty chemical companies globally. Now, I'd like to request our presenters, our leaders, to kindly come on stage. So everybody, let's welcome on stage Mr. Kaushik Roy, Managing Director, PCBL Limited, and along with him, Mr. Raj Gupta, CFO, PCBL Limited. Can we welcome them with a round of applause, please, everybody? Thank you. I get the afternoon slump is a legit word. Over to you.
There's a presentation on company, what we are doing, what we have done, what are our plans. Of course, I will make this presentation, but I think today it becomes important. You all know about PCBL, most of you, right? You have heard, you have seen its content, you have seen annual report, maybe ratings, etc. So every one of you would have some perception about the company. The company has gone through a massive transformation in last 10, 12 years, and I think before I start the presentation, it will be important for you to understand what we have done in last 12 years, which sets the platform on which today we stand, and which is going to take us into the next orbit going forward. Now, PCBL, it is the oldest company of the group. It started operations in 1962, was set up in 1960, started operations in 1962. If I were to divide the history of PCBL into major phases of its history, I would do it in 3 or 4 major phases. And all these phases were important from the perspective that it set the stage for its next phase of performance, how it performed and why, what it did and why it did in the next phase. So now, going back into the history, the initial few years for the company were extremely good period for the company. So it started operations in 1962, and we all know that Indian economy was a closed economy for time till maybe late 90s or early 2000s. And like most of the things, even carbon black was in scarcity in India. So a very happy period, initial 40 years, we made a lot of money, distributed dividend every year. Good time for business, but then what also happened simultaneously, parallelly was, it created a lot of complacency in the business. So there was lack of focus on portfolio building, lack of focus on investment in supply chain bandwidth, in operational efficiencies. Our only focus was to get license from government to manufacture more. And our customers will literally queue up in our offices just to secure allocation. And that's what we were doing, manufacturing and allocating. Beginning of 2000, China started investing in its steel capacity. To invest in their own infrastructure, to cater to their own infrastructural requirement, and also to cater to global steel demand. And in the process, they set up 50% of global steel capacity. In less than 10-15 years, they built up this size. And most of you would know that the conventional steel manufacturing process was based on blast furnace mechanism, which required coke in smelters, and coke is a byproduct of coking coal. The conversion process of coking coal into coke releases a lot of coal tar. So the liquid portion of coking coal comes out in the process. And one point in time, there's so much coal tar coming out of steel factories that China even had problem of disposal of this material. They didn't know what to do. Coal tar had usage in number of industries, but the quantity was so big, they had problem using it, handling it. Eventually, they discovered that this is rich in carbon and can be an alternate source of raw material for manufacturing carbon black. With this discovery, Chinese government gave massive incentive One point in time, this industry enjoyed 28% capital subsidy. Add to that the logistics efficiency because of local availability, and because of abundance, availability in abundance, the price point was far more economical than its crude counterpart. Prior to this discovery, entire carbon black manufacturing globally was based on crude-based feedstock, the residual oil, which remains in the refineries when crude is distilled. This was a newfound material. And with everything working for the industry in China, they kept on adding capacity. Eventually, they reached a capacity size of some 40% plus globally. Again, they had more than what they required for their domestic consumption. They started dumping it all around. They wanted to eliminate competition from the surrounding countries. And first time in 2004, PCBL saw losses. We came into losses. The story doesn't end there. The problem was we didn't know what to do. We never faced competition. We had always made profit, and we didn't know what to do. Now, and it started happening year after year. Now, the number of views were taken that point in time. Some of views were speculative in nature. Because our raw material was crude, there was a view that crude prices would only move up, and therefore if we stock up more on raw material side, eventually prices will go up. We will be sitting on low cost inventory, and therefore we will make better margin. Also, most of the raw material that we used to purchase then was imported. And therefore, if we are buying more, then we can also use larger vessel size, and consequently our per ton freight cost would come down. So this was one view, that let's buy more crude, more raw material, let's stock it up. And second, because of imports, we also had exposure to currency, exposure to dollars. And back then, I'm talking about that era, 2003-04. The currency premium used to be very high. Hedging cost used to be somewhere around 7.5–8%. And there was a view that rupee may not depreciate every year by, this much, 7.5–8%. And even if it does, we will still not be losing money. We started taking mark-to-market exposures. In some period, the views proved to be correct. We did make money. In other period, like 2008 or 2013, when there was very high volatility in crude and currency, we bled. 2004 and 14, during this 10 years, there were 5 years in which we were into losses. 5 years we made money. Altogether, maybe combined effect of all these speculative calls, we might have made money. We don't know, because accounting regulations also changed over a period. We may have lost money, we may have made money. The real damage was not that. The real damage that all these speculative calls did to our business was it created a perception of our business being a very short cycle in nature, a very volatile business. Most of our stakeholders got scared, worried. We ourselves got worried. The board decided to change the management team, leadership team. 2014, Mr. Roy was brought in. He was with Apollo Tyres. And then there were other changes in the leadership team. We got a new manufacturing head, new marketing head, new projects head. A lot of changes even down below. And the idea was to not be prisoners of perception as to how this business should be run. The idea was to see the business from a new set of eyes. The idea was to explore whether this business has some fundamental flaw or there is some policies that we have to do away with. Well, the new team came together. and it also decided to engage McKinsey. All of the new leadership team members were from different industries, and none of them were from carbon black industry. McKinsey engagement remained for about 1.5 years' time. There are a lot of fact findings. And the idea was that we wanted to understand as to what few things we need to do in order to make this business more sustainable, more profitable, more stable. That engagement remained for 18 months. There were a number of discoveries. But 3 major things came out of the exercise which we decided to focus on. First was McKinsey said, okay, you manufacture carbon black, let's look at how efficiently are you manufacturing it. Let's compare the input-output ratio of each of the grade that you manufacture with your peers. And in our business, almost 70% of our top line is raw material cost. Even a small percentage improvement there has a big impact on bottom line. To give you an indication, 1% of yield improvement is about 1,500 to 1,600 rupees bottom line at current crude prices. So we had about 40 odd grades in our portfolio then. Each of them were compared with the other manufacturers' input-output ratio. That was one thing which happened. Second, they said you manufacture carbon black, but then you are only making what is very easy to make. Some of your peers globally, they have in their portfolio also special grades, value-added grades. What you are making is only for tire. What they are making is also for other applications. As long as you continue to make what is easy to make, the smallest of the manufacturer will give you competition for your money. So you need to invest in your capability. You need to create a portfolio which is not easy to break, which has technological barrier. And the third discovery was, they said, well, we see that you are present in international market, you have customers, but we see wide fluctuation in your volumes in international market across different time points. And we see that when Indian tire and auto industry is doing well, your volume in international market is going down. So what essentially you are doing is you are doing surplus management. You are not a strategic supplier to your customers outside India. And therefore, you face challenges of capacity utilization when Indian economy doesn't do well, and your margins in international market are also bad. Like I said, the engagement remained for 1.5 years, 3 major discoveries we decided to focus on. This was easier. Identifying the focus areas was still one of the easiest thing. We decided to start working on this. And just to again add here, our balance sheet was also in problem. We had a leverage of almost 2.5 times of EBITDA back then. So very levered balance sheet back then. Did not have resources. But we decided to invest in all these 3 focus areas. Between 2015 and 2020, so in each of these 3 areas, we decided to work. And with regard to the input-output ratio, the gap between us and the best manufacturer's efficiency, if you were to combine that, no one had best efficiency across grades, but if you were to combine best manufacturer's efficiency across all the grades that we had in portfolio, the gap was almost 7.5–8%. And 2015, our per ton EBITDA was 7,000 rupees per ton. That's what all we are making. We started focusing on each of these areas. 2015 onwards, we created a very small, what we then called technical capability center. It was not an R&D center. We started with, getting people who had some kind of expertise in product development, in technology, process technology, equipment technology. And we created a very small team, and we named that Technical Capability Center, TCC. Between 2015 and 20, we could create a strong team of about 40 professionals, most of them scientists or chemical engineers or technical experts. 2 centers, one in India, one in Belgium on R&D side. We set up 7 offices in global markets. We identified geographies which had a lot of potential for growth, and we decided to invest there, invest in our supply chain capability. So we set up offices, local offices in those geographies. We invested in warehousing facility. We set up decanting stations. We also tied up with the local distributor partners. And we started looking at the design of our equipment, the processes that we follow. And we created a separate process technology team to help us improve our manufacturing efficiency. By 2020, like I said, we had 7 global offices. About 8% of our volumes were coming from high-end specialty, another 25% coming from value-added product portfolio. About 30% of our sales, more than 30% of our volumes were getting generated in international market. And our yields were up by almost 4% in that period. By 2020, we were already doing some 13,000 rupees EBITDA per ton, almost double of what we had back in 2015. A lot of hard work in that period. The whole idea was to bring the company back on track in terms of capability, create capability across functions, across operations. We lost about 1.5 years in COVID. Otherwise, our next phase would have started. So the first phase was between 1962 and 2004. The second was from 4 to 14, which was a very volatile period. We didn't know what to do. The third was the new team coming in and starting building the company back, bringing it back on track. And the fourth stage, which should have started in 2020, started a little late in 2022, 21 or 22. That's about high level of automation, high level of digitization, high level of focus on sustainability and growth. And in last 2.5 years time, post-COVID, we started investing in growth. Post-COVID, we have already added 150,000 tons. Another 110,000 tons is in pipeline, which should come up in next 1.5 years time. There has been technological tie-up with an Australian company. There has been an acquisition, $500 million. It adds chemistry to our portfolio, a different chemistry to our portfolio. And our R&D bandwidth has further increased in this period. Currently, there are more than 50 scientists and PhDs and chemical engineers who work. And we have been launching newer grades every year. Last 3 years itself, in our conventional portfolio, we have launched about more than 30 grades. And the pace is only going to increase from here. So it's a different company. It is not the company what the company was maybe back in 2015, or for that matter. What you are seeing today is different from what it was in 2015. What you are going to see in next 5 years will be a very different company from what you see today. And with this, I start my presentation. I think this background will help you understand the new PCBL. I'll skip some of the group slides because morning session, you got an overview, and then all the companies presented their businesses. Very, very large group spread across geographies, 9 sectors, some 33, 34 businesses. And these are all 24 numbers. Numbers, of course, have gone up in the first quarter. These are the priorities, strategic priorities of the group. I'll just skip all these. Yeah, so we come to PCBL, and I'll take you directly to what we are. Hello. Yeah. As you see, currently we are seventh largest in the conventional space. We added Aquafarm Chemicals to our fold couple of quarters back. Currently, the combined chemical capacity is about 900,000 tons. In 5 years' time, we are going to become 1.5 million ton capacity, one of the largest chemical manufacturers globally. Across geographies presence, we have 9 plants, 9 manufacturing facilities, India and outside. A very strong portfolio of 300 plus grades, out of which about 140 plus grades are of high-end specialty. More than 300 customers globally. Currently, we are seventh largest, and in a year's time, we are going to jump 2 ranks globally. So in carbon black space, we are going to become fifth largest. My voice is clear or it is fluctuating? You all can hear me? Right? Very wide product portfolio catering to number of applications. The conventional segment, we make products which cater to all kind of tire applications, starting from cycle tire to the racing car tires. One of the biggest brand in carbon black space globally, most respected brand globally. Performance chemical segment caters to construction and automotive industry primarily, plus the industrial rubber. So starting from conveyor belts to shoals, rubber sheets, power transmission belts, hoses, ducting, and then the specialty chemical portfolio, which we started in 2015. We started with zero. Already it accounts for almost 10% of our total volumes. And again, very wide variety of applications, starting from ink, pen, dyes to conductive grades like batteries, which gets application in batteries, wires, film sheets, adhesives, sealants, and newer applications are being found around the specialty carbon black. Aquafarm we acquired a couple of quarters back, 3 major segments they are catering to. From raw material side, if we consider, then there are 4 major segments. One is phosphonate based, then we have biodegradable chelating agents, polymers, oil and gas chemicals. And from end user industry perspective, there are 3 major segments that Aquafarm caters to. One is oil and gas, the second is detergents, and third is water treatment. I was talking about how the portfolio has been changing for the company. There was a time when almost 100% of our volumes would come from the conventional portfolio, which was tire. And today, tire is just one of the 5 verticals that we have. And last few years, there has been a lot of research which has gone into the tire grades also. Currently, we have grades of carbon black which provides a lot of qualities to tire like better rolling resistance, fuel efficiency, lower abrasion, longer mileage. And those are all grades where the entry barrier is very high, and consequently those grades also carry very high margin, which are like tire specialty, which are not off the shelf grades of the conventional tire portfolio. Then performance chemicals currently account for almost of the conventional business, about 25-26% performance chemicals. This is primarily construction and automotive industry. Again, very high level of customization in this portfolio. Specialty chemicals, mostly around engineered plastics, then the colorants, ink, paint, dyes, adhesives. The conductive segment is batteries and wires. Again, we have been launching newer and newer grades every year. The portfolio is expanding. In specialty, we grew from 0 to 10% now in terms of volume, and it is expanding further. And it is just not the vertical growth in terms of our adding capacity every year, but we are also launching grades every year. So it is horizontal as well as vertical growth for us. And water treatment, detergent, and oil and gas is the newest segment, which came to us through acquisition of Aquafarm. All these segments are growing rapidly. There are growth drivers. Automobile industry in India has done well. Our market share globally has consistently been going up. And in the value-added segment, our portion is still very small. We have just a very small fraction of the market share. And with the kind of investment that we are making in building up supply chains, it should take off from here very rapidly. This is our leadership team, all very experienced, more than 2 to 3 decades of work experience across companies, professionally qualified. They have worked in different leadership roles. These are some of the key trends for the different products that we have or product segments that we have. Carbon black industry historically has grown at about 3.5% CAGR. Indian tire industry, of course, is growing at a high rate, so consequently, Indian carbon black industry would also have similar kind of demand growth going forward. Then household, institutional, and industrial cleaning, again, it is growing at 7% CAGR, very high growth rate. And there is a trend of increasing hygiene awareness among the industry participants. Oil and gas industry in recent past has started growing at a little elevated pace. Last few years it did not grow much, but now again it has started growing with increasing energy demand. And industrial water treatment, that segment is growing at about 4 and 5%. Battery chemicals is the fastest growing segment, where the electrical vehicle market is projected to grow at 40% plus CAGR growth. But even the battery chemicals, and especially the anode chemicals where we are present, that is growing at about 25% CAGR. The market size is currently small, about 15,000-20,000 tons, but it is growing at about 25% CAGR. Sorry, there's some disruption and some problem here. Now, this is again part of the industry dynamics. What is changing is in carbon black industry, historically, China and Russia both were big forces. Russia had its own crude and China had its coal tar. And therefore, manufacturing in these two geographies were far more economical as compared to other countries. And both of them had very large share of global market trade in carbon black, both accounting for almost roughly about 30-35% of global trade that happens in carbon black industry. So they were doing about 700,000 tons each of exports in global markets. China, like I said, because of its cost issues, the coal tar prices in China have moved up significantly from where it was. What gave it advantage now is working against it. Post 2016, when the new emission norms came in, China's carbon black industry witnessed a very significant consolidation. Their cost structure has changed for worse. Now they're no longer a force in carbon black industry. They still have capacity, but doesn't have as much power on the pricing and margin side, and which is reflecting in the level of their capacity utilization. You will see the level of capacity utilization has steadily come down over the last few years, and currently they are operating just at about 60%. Theoretically, the industry can operate at about 80% capacity. And also, with the cost efficiencies withering, the level of exports from China is coming down. The chart on the right-hand side is reflecting exports to Europe. But generally, China's exports in global market have come off in last 5 years, and it is steadily coming down. 2 years back, when the Eastern European crisis started, European Union decided to put a ban on Russian carbon black, which officially got kicked off from 1st of July. And as you see, while the restriction or the sanction got effective from 1st of July, it has already started reflecting in Russia's export to Europe. Now, while in last 4 or 5 years, we have been doing decent business in international market, but Europe was still very difficult geography for us to penetrate. We did invest in Europe in building infrastructure, but the pace of growth was not to our satisfaction. But now with this new development happening, in last 2 years, our volumes have started improving in Europe also. As we speak, our volumes in Europe has increased from about 4% 3 years back to about 20% plus. And the opportunity is very big. So you see that between Russia and China, they were doing about close to 450,000 tons of exports to Europe. That's the level of shortage which Europe faces and which it imports from outside. And now with Russia out of favor and China having its own cost issues, the opportunity for India becomes really big. Similarly, the opportunity in water treatment, detergent and oil gas products also is equally strong. All of them are growing at about 3.5–4% growth rate CAGR. The industry size is fairly large. Our share currently is very small, just a fraction of the overall market size. So equally big opportunity for us to grow in this segment. Green chillets is the latest segment in which their R&D team has launched some grades. Very small again. Currently, some research is going on in their labs. We have been able to develop some grades, but there are new grades which are currently in lab and which we will be rolling out soon in next couple of quarters' time. Industry size again is very big, already at about close to 200,000 tons and growing at a 4% CAGR. We hardly have any market share of this. Currently, we are manufacturing about 4,000 tons here, and we believe that going forward, we are investing in capacity, we are launching newer grades. We believe that in next 4 to 5 years' time, we can reach about 35–40,000 tons of green chillets volumes. Now, coming to what we are doing in order to accelerate growth. We did take few steps in last 5–7 years, and we created a better foundation of PCBL. Now, the whole idea was that we create a strong foundation on which we can grow rapidly. And from here on, again, economic activity, we are seeing massive economic activity in India, and we want to participate that. Plus, our own operations have become very efficient, both on cost side as well as on operational efficiency side. What we have been doing in last few years and which is going to provide us support on our growth aspiration, there are the 6 levers of our growth. I'll take you through them. I was talking about our investment in process and equipment technology, and today we have very advanced equipment and manufacturing processes. There is a dedicated process technology team which help us design our reactors, which gives us better manufacturing efficiency than what we had earlier, and which kind of improves our manufacturing efficiency. There is very high focus on cost and efficiency across all operational, major operational areas. Dedicated equipment technology team, again for optimization of field. We are self-sufficient in power. We don't, and we also have surplus power which we sell in market. And then all of our manufacturing facilities are in proximity to ports and to customers, which again makes us logistically very efficient. So we have an advantage now with all these things working for us. We are one of the most efficient manufacturers in our space. I was talking about our investment in global supply chain. We started with almost zero. We had no investment, no infrastructure in global markets. Today, we have more than 20 warehouses, about 21 global offices, 3 R&D centers outside India, 6 decanting stations, and then marketing presence in 60 plus countries. So very strong geographical presence, have our own infrastructure, our own people outside India, and now we are eyeing to increase our market share globally across product segments that we have. Product portfolio, we have worked a lot. I was talking about it. Started with tire. Today, tire is just about 36% of the combined portfolio. 64% coming from value-added chemical portfolio. I was talking about tire specialty. A lot of grades we have launched there, provides superior quality to tires. Some of these grades have been developed in joint collaboration with tire companies. Performance chemicals, lot of customization on the grades that we have. So these are mostly these are customized grades which caters to industrial rubber, automotive parts. Specialty ink coating, paints, batteries, conductives, those are the end applications. And then the newly acquired business, Aquafarm, where we have green chelates, polymers, oil and gas chemicals, and phosphonates. Currently, it accounts for 14% of the total portfolio. In last 6 years' time, the value-added chemical share, which was 25%, has increased to 64%. With Aquafarm coming under our fold now, we have 3 R&D centers, 2 in India, 1 in Belgium. There are more than 85 professionals who are working in these facilities, very experienced, and we have launched 40 plus grades, more than 40 grades in last 3 years, spending good amount of money on R&D initiatives, and also spending a lot now on green technologies. We are adding capacity across product segments, about 110,000 tons in carbon black underway. Another greenfield is on the way, which will give us another 150,000 tons. In 1.5 years' time or 2 years' time, we should be crossing 1 million mark in our conventional space. Aquafarm, we will be doubling capacity between now and next 5 years. We are adding 3,000 tons of capacity in 3 to 4,000 tons of capacity in battery chemical space. Together, all of this will take us to about 1.5 million tons of combined capacity in next 5 years' time. I'll be fast. I'll be little fast. Okay. And this is one of the pillars. I mean, we started investing more in digitalization. We wanted to harness more data, capture more data, identify areas where there's scope for efficiency improvement. And this is the latest plant that we put up in Tamil Nadu, based on Industry 4.0 technology. Technologically very advanced, one of the most efficient plant globally. And this technology is also going to give us insight into how to make our other manufacturing units equally smart and equally efficient. Lot of work, good work that we have been doing on sustainability side. Currently, we lead the industry in terms of initiatives that we have taken on the environment side. We are the lowest emitting carbon black producers globally, better than the leaders of the industry, Cabot and Orion. Currently, a lot of good work. Every year we are planting saplings. All our facilities are currently zero liquid discharge. Some of the ratings that we have got. Our manufacturing process also generates a lot of tail gases, and we utilize those tail gases for power generation. So this is green power. We are first carbon black company globally which got accredited under UNFCCC protocol. Currently, we have 122 megawatt, about 40% of which we consume internally, and balance 60% is available for sale in market. A bit on financial performance has improved steadily last 10 years. The current chart shows only last 4.5 years. Revenue has grown by 34%, EBITDA 27%. EBITDA per ton has also improved from 13,000 to almost 21,000 rupees and growing. And this is what our business plan is for next 5 years. In carbon black space, we are confident of achieving 12% CAGR growth. Similarly, in water treatment, detergent, oil and gas, about 15% CAGR. Battery chemical or nanosilica is a new space. So we should reach a capacity utilization of 2,500 tons going forward. And these are some of the financial numbers that these capacity utilizations will convert into. So friends, this is it from my end. Now I open the house for your questions. Thank you.
So questions?
Thank you.
Thank you, sir, for the opportunity. Sir, this is Aditya Ketan from Stewart and McAtich PMS. Sir, my first question is on to the CBO. So currently we know that CBO prices are above the CBFS, and this trend historically we look, so the CBO prices were lower. So for the last 6 to 8 months now the CBO prices are higher than the CBFS. So you see any risk to this trend? So now coming down, so so the CBO prices again coming down below CBFS?
The trend that we see is, so the lower CBO prices prior to 2015 was because there was a lot of coal tar which was getting generated, right? And with steel manufacturing process gradually shifting from blast furnace to electric arc, the level of coal tar generation has come down, and consequently the price point has gone up. It is unlikely that it is going to come down, but what we have done in recent past is we have also focused a big way on our input-output ratio. So our yields have also gone up. So our own manufacturing efficiency now improving. Even if theoretically tomorrow the gap between CBO and CBFS comes down, it is not going to impact our positioning in terms of margin or price.
But sir, onto the yields also, like you mentioned, so I believe last so 2 to 3 years our yield was somewhere around 1.8. Now it is around 1.9. So you see any significant improvement in yields from here on going ahead?
You can't, I mean, it is not like-to-like comparison because the portfolio is also changing. The portfolio that you see today that we have is very different from the portfolio we had maybe 7-8 years back. Typically the yields in specialty and performance segment is lower than the yields in the conventional grades which are off the shelf. So it is not comparable, but like I said, our journey is not finished yet. We started this journey, we have achieved part of it, some mileage, but it's a long journey. And when we started, our insight or our understanding of the processes was not what it is today. So the scope has further improved.
Sir, my third question is on to the spreads into carbon black. Sir, when we put up a greenfield plant of carbon black, around 60 to 65 rupees per kilo is the capital cost. Today, sir, we are making around 20 rupees per kilo as an EBITDA. So it is almost a 3 times payback, almost around, you can say 35% ROC. So these numbers are sustainable for the longer term, or it is only a short-term trend which we can see?
Yeah, these numbers are not only sustainable, but certainly there is scope for improvement. Our product portfolio is improving, our manufacturing efficiency or operational efficiencies are improving, and there's a fair bit of operating leverage that we are going to get out of capacity addition. But then when you calculate ROC, there is also a working capital, so you need to consider that also. 65,000, what you're saying is just the capex. There's another about 15-20% on it, which will get consumed in working capital.
So just one last question, sir. Sir, any estimate on EBITDA for Aquafarm in FY28, 4 to 5 years down the line?
We believe, see, about a year back, it was doing about 20% EBITDA. Then industry went through the soft cycle, and currently they are making about 15-16%. Now, there are 2-3 things. One is generally there is pricing pressure in the industry, and therefore the margins have come off, right? But somewhere it appears that it has bottomed out, so it should from here move up only. That's one. Number 2, they are not operating at full capacity. They are currently operating at about 75% capacity utilization. With capacity utilization increasing again, operating leverage will play favorably and their margins should improve. And third, all the new, these green chemistries that they are adding to their portfolio will also pull up their margins. We believe by 2027-28, they should be somewhere around between 23 to 25% kind of EBITDA margin profile. That's how we see it.
And sir, this, into the conference call also you have mentioned that you are anticipating almost a 5 rupee per kilo EBITDA improvement. So this will come from Aquapharm or from the carbon black business?
No, when we were talking about the increase in EBITDA, we were primarily talking about our conventional business. So we were not talking about the combined business. We were talking about because there you can compare it like to like.
Okay. Thank you, sir.
Thank you.
Yeah, hi Raj. This is Sanjay here.
Hi, Sanjesh.
Hey, hi. So quickly on this Aquapharm again, if you look at the history, on the growth side, organically they have not grown at the pace we are anticipating. The promoter who have run this business for 20 years. So what different we are trying to do, which promoter didn't do, who was running this business, which is giving us the confidence of growing at 15-20%. In a market where we are already 25% market share and the growth is 3 to 5% globally, and China obviously remaining competitive both on phosphorus side and in the end market. That's number one. Number two, margin again, in the best of the phosphorus time we did margin of 23-24% in the Aquapharm. We are talking of a sustainable margin of 23 to 25%. Operating leverage apart, this margin for me at least looks from an historical data a very aggressive point. How do you justify that?
I'll answer your question about margin first and then I'll hand it over to Mr. Roy to answer your question about Aquapharm growth, how we are going to sustain. Sanjay, if you look at Aquapharm's gross margin profile, historically the best that they did was about 45-46% and the worst that they did was about 35%. So the margin profile is good. Even in the worst of the scenario, they are still doing 35%. Right? And when you compare it with our conventional business, currently we are going through a good period, right? And we are doing about 30-34%. So in worst of their period, they are performing better than that. They are doing 35%.
I don't think comparing it with carbon black is the right thing to do, right?
There is no comparison, but I'm just highlighting as to what could be considered as base gross margin for them, right? Now, if we believe that chemical industry has gone through its worst and going to recover from here, then of course pricing and margin changing, I mean past pricing moving up automatically would play somewhere on the margin. So that itself would improve margin by some basis points, few basis points. Then all these new products that they're launching, especially on the polymer and green gillette side, those are high margin products for them. And the markets are also primarily Europe and North America, which are not very price sensitive market, right? And in past, a lot of it was being supplied by China, but now they have imposed tariff barriers on China. So again, it creates an opportunity for them to fill up the gap from there. And operating leverage is also very important here, Sanjay, because historically also if you look at, they had never been able to utilize their capacities fully. Right? Last year they were operating at about 68%. This year, in couple of quarters time, we have been able to jack it up to 75%. Our aspiration is to take it more towards 100% by fourth quarter or first quarter of next year. And we are also adding capacity. So the operating leverage is not limited to the balance 25%. The new capacities which are coming up will also play a role in operating leverage. Additionally, the combined efficiencies of the business, so like the logistics costs that they were incurring, and most of their sales come from overseas market. India is just about 10-12% of their business, the rest all comes from outside India. So when we are combining our logistics team and their logistics team efficiency together and renegotiating the contracts, the freight contracts that they had, there's a lot of low hanging there. Already, I mean, in this short period of time, we have been able to reduce freight rates by almost $15 a ton. And this is just one of the initiatives. So all these initiatives are going to, somewhere reflect on the margin profile. except last couple of years, I mean, 23 and maybe current year, they had been well about 20%. And when we look at the portfolio that they are building, plus the initiatives that we are taking internally and operating leverage playing its own role, we feel fairly confident that by 26 only, we should be again, get back to 20% plus, and then gradually improving from there. Regarding expansion of market and why the market could not be expanded, I'll request Mr. Roy to answer.
So Raj is thinking that I'll go to sleep, so therefore he should pass on the mic to me. So I think as already shown by him, there are 4 categories within Aquafarm. Currently there are 4 big categories. One is obviously phosphonate, which is the largest business for them at this point of time. And in the space of phosphonate, excluding China, when you look at them, they are either number 1 or number 2 in the globe. There is one company from Italy, so it is a competition between that Italian company and Aquafarm. So we are on a strong wicket as far as phosphonate is concerned. Having said that, focus will still continue to grow in that area also, because it gives a decent margin, a decent return. So that's number 1. So other 3 you look at, one is polymer, one is oil and gas chemical, and third one is green chelate. Instead of the traditional chelating agent, we are talking about green chelate here. All these 3 segments, if you look at and compare it with the global market size, you'll realize, he showed it, the slide you have seen, it is just about a percentage point here and there. Plus minus 1%, less than 1% or more than 1%. So therefore, there is a lot of headroom there. The customers in this space are heavily dependent on globally, typically, couple of companies. I will not name those companies, you can do the research yourself and find out. And they are looking for a third viable, dependable, trustworthy option, technically capable, trustworthy option. Aquafarm fits that bill very well, fits that expectation very well. They have this technical ability, R&D ability, so to work with them, can provide a good service. As an organization, and since it is small compared to those global giants, they are much more flexible in terms of collaboration. So that is one big advantage for them. So it is a perfect environment for Aquafarm to grow with these customers like, say, Procter & Gamble or a Henkel globally, to have a third space in that area. But the moment you get some share, you can imagine that 1% share what we have today, and if you get something from the big ones, automatically it will go up substantially. So that is the reason we are saying we are quite upbeat in terms of growth of Aquafarm. And as Raj mentioned, in terms of profitability, it is not just about focusing on these 3 segments and phosphonate, but also we are looking at excellence in operation across the whole organization in different functions, more so in the area of manufacturing. That is going to give us a lot of benefit. Procurement will give us a lot of benefit, because when we looked at it, we realized there are some low-hanging fruits in procurement also. Chairman today talked about, and we are examining it, the possibility of backward integration of getting into yellow phosphorus from rock phosphate, converting it from rock phosphate to yellow phosphorus. If that happens, there's a fairly large amount of margin which can be unlocked. So it's a combination of these 3-4 things. And growth numbers, Raj has already shared. We are looking at a decent investment over a period of time. Already they have a capacity of 130,000. We are adding 38,000 in India. The work has already started. We are looking at USA to add further capacity. And as we go along, we'll keep on adding capacity. And possibly in next 3-4 years' time, you'll see the capacity is doubling and going up beyond that also.
Kaushik sir, on green chelating, when you said that this large MNCs, consumer company, small market share can make a big difference for us, where are we in terms of validation, product supply? Are we already supplied? Are we getting some contracts? Where are we in that entire process?
Right. We have already developed some of these products. There are 3-4 products in this particular category in green chelating. We have already developed a couple of them, and we have given them for sampling, and it has already got approved. So the seeding has already been done adequately. So it is now a question of converting that in a big ticket commercial production and become a regular supplier. So we are in very close coordination with some of these customers, which just now I took the names, and just it's a matter of time that we'll be coming out with that kind of volume. and then the supply will go up with these customers as well.
Kaushik sir, one on the carbon black. Now, if I look at this industry is growing at 3 to 4%. Assuming in next 5 years, this industry will grow by say 12 to 15%. So 14 million metric ton will add say 10%, which is close to
About 500,000 tons every
So we
year.
are telling we will be taking away almost 33% market share in the incremental growth. If we are telling that the industry will grow from 14 million to say 15.3, 15.5, and we are going from 0.7 to 1.2 or 1.3, we are telling that effectively we will have 33% market share in the incremental carbon black. That's what we aspire to do.
Yes, absolutely correct. But I think you have to look at it slightly differently. Raju will just explain it to you why we are saying what we are saying.
Okay, so we have to put a hard stop here because we are done with the sessions. Okay, okay.
I'll answer and then maybe we can wrap it up.
Okay.
So Satish, when we say 3.5-4% growth, global industry is about 14 million ton, you know that. 3.5% growth converts into almost 500,000 tons, you calculated. Now, in absolute terms, this 500,000 tons may not look very big. But when 70% of the consumption part of the world is not adding capacity, see, North America is not adding capacity, Western Europe is not adding capacity, China is consolidating, and Russia is out of favor. So who is going to even produce additional 500,000 tons every year? I think the challenge is that. It is not that where this 500,000 tons capacity will get absorbed. Today, situation is such that even if we had a new greenfield plant ready with us, we would have been able to sell it in less than 6 months' time. That's the situation. And we believe that this is going to, and global economy is currently not growing at its peak. Auto industry in multiple parts of the world is not doing well, right? It is facing challenges. Now, once this geopolitical issue subsides over a period of time, and when the demand again comes back to normal, the market is already in short supply, and this will become even more acute going forward. So I think the industry is going to remain in a short supply situation for time to come.
Raj, are we being too optimistic on what's happening in the near term in terms of demand supply? We are adding so much of a capacity, and we have seen this many times in the history. This industry lead to an overcapacity, then things normalize over a period of time. Are we taking a calculated risk, or we are being too confident this time to tell that no, we will still add a 500,000 metric ton of capacity?
Yes, I would say, first of all, even when industry had oversupply situation, it was not very significant. The industry was never in significant oversupply situation. Only China and Russia had significant more capacity. And if you look at global supply distribution, it was China who created that problem of oversupply. Today, with China playing a passive role in the industry, that threat is not there because most of the countries which produce carbon black, they don't have size. It's very small. Other than India and Russia, China and USA, none of the countries have more than 1 million ton capacity.
I think they are waiting to close.
And we can take it offline. So
We'll
going forward.
All right, so all the remaining questions you can take offline. They will be around for a few more minutes, I guess. So thank you. With this, we are coming to an end of RPSG Investor Day today. And thank you very much, Mr. Kaushik Roy and Mr. Raj Gupta. Everybody, can we have a round of applause for our presenters, please? Thank you, everybody, for being here with us. It means a lot. And the tea is served right at outside this door. So please have your tea. And with this is me, your MC Vyoma, signing off. Thank you so very much. Have a great evening ahead.